This is such a predicament of Cirrus research. The latest issue of the model behavior is just out. The title, Implications of a Value Rotation. You've seen work from us in the last few months that have suggested that the profit cycle appears to be bottoming. Expectations for earnings are on the rebound. And as a result, this idea of a Fed rescue and sharp rate cuts have been really pushed out into a 24 event if that occurs. As a result, we are finally starting to see the effects of a stabilizing economy. And a couple of things are going on. One is that we are seeing a ratcheting up of the long bond on yields, and that's also now driving a very different behavior in the marketplace. A couple of things to walk through. One, our Cirrus style oscillator, and this is sort of a diffusion model that looks at several factors that says, should we lean towards growth stocks? Should we lean towards value stocks? On the lower tranche of this panel, what you'll find is that this would be a value leaning. On the upper panel would be a growth leaning. So what we've seen in the last 3-4 months is a precipitous move towards value. And this is important because the implications for this are strong. If you do get a value rotation and even a marginal value rotation, the sort of very tight leadership we've had in this year will begin to reverse. We've already begun to witness some signs of that. Another really important data point, however, is also in terms of absolute returns. If you look back over the last 30 years or so, what you'll find is that growth-driven markets tend to be higher returns. Value-driven markets tend to be grittier and lower returns. So what you'll find here, this operates both with large and small caps, is that we tend to have the market as a whole tend to be higher expected returns. The market as a whole tend to be lower expected return when you're in value. This differential, though, is amplified that in the growth cycle, the growth indexes tend to lead quite a bit. And when you're in the value cycle, the growth group actually gives up a bunch of ground and the value group continues to deliver growth returns. So that's really a nuance, but I think it's a really big deal in terms of how we're framing our expected returns. Importantly, when we look at timing of the cycles, how does this oscillator work? The report goes into some of the backtest results. And bottom line, whether you're in the large cap camp or in the small cap camp, what we'll find is by applying the CSOs, what we're finding is a superior risk-adjusted return comp. So you'll go, for instance, in small value. The absolute return here is roughly about 8.2% with a certain amount of vol. What you'll find is you'll get another 70 basis points move with the oscillator making signaling the rotations. Similarly with growth stocks, what you'll find is a much lower level of vol and also increased returns. Take a look. There's a lot in this report, and as always, we'd love your feedback. Thank you.